This is FRM Part 2, Book 5, Risk Management and Investment Management, and the chapter on factor theory. This was written by a gentleman by the name of Andrew Ng, who previously was a professor at Columbia University and who, as of 2020, leads the factor-based strategies at BlackRock. And I mentioned that just to kind of emphasize that this chapter is written by, now notice it's called factor theory, so it's written by an expert in this area. And you'll see that as we look through the learning objectives, and then I'll remind you about this throughout the slide deck. We'll go ahead and start with a definition and a description of factors and factor risk premiums, and then we'll move on to the one-factor model. And you guys are probably familiar with the capital asset pricing model, so we'll talk a little bit about some things that you probably already know, but hopefully I'll be able to add some value to your understanding of CAPM as a one-factor model. Then, of course, we'll move on to multi-factor models. Then we'll have a couple of really good slides on stochastic discount factors, and then end with a discussion on efficient markets theory and hypothesis. So let's start with factor theory. What I want you to do is I want you to think about having a portfolio of just those four stocks in the middle, right? We know about those four stocks. Everybody knows those stocks. And just for argument's sake, let's suppose, even though it's not true, let's just suppose that this is a diversified portfolio. What we know is that the price of each of these four stocks is sensitive to changes in information. And in the traditional modern portfolio theory, this is summarized in the capital asset pricing model with the market portfolio. But what we also know is that inside of that market portfolio are common factors that will influence the performance of that market portfolio. Look at those common factors there, and you know about these: interest rates, what the floor of the New York Stock Exchange is doing, etc., inflation, changes in GDP. But here's the idea about factor theory, is that when interest rates change, that change is probably going to impact each one of those four stocks, but probably not by the same degree. And so factor analysis and factor theory tries to identify those common factors and how they will impact the change in prices of each of those four stocks. And of course, not just those four stocks, but all of the thousands of equity securities. And this, of course, can be extended to fixed income securities and derivative securities and alternative investments, et cetera, et cetera. And that's why we have down at the very bottom that these factors are going to determine what kind of a style that we like. What kind of an investment style do we prefer? Value, growth, momentum, or some kind of bet on volatility. How about examining that part of the learning objective about the primary principles of factor theory? All right, what really matters is the factor, not the asset. What matters is, here, let me go back here. What matters is the change in interest rates. What matters is the change of inflation. What matters is the change in economic growth, not so much Apple or Bank of America. So the investor must look through the asset identity in search of the underlying risk factors because, I mean, let's face it. Here, let me go back here one more time. Suppose that you believe that these four stocks are very sensitive to changes in interest rates. And let's suppose that you just, for some reason, believe that interest rates are going to spike in the relatively near future. Well, what this factor theory will enable us to do is to determine which of those four, let's just pick one, which of those four is going to fall by the least amount when those interest rates do in fact fall. So the focus is on the factor and not so much on Apple, which, and look in bold there, ultimate determinants of return. And those assets, of course, those four stocks and all the other assets represents bundles of factors. Let me go back one more time. Of course, Apple stock is influenced by all of those factors and maybe a handful of more, maybe 5 more, maybe 100 more. And so we have these bundles of factors, which means we need to consider things like, oh my gosh, correlations and copulas. Optimal risk exposure varies from investor to investor. Of course, I may have my own personal preferences, ability and willingness to take risk. You may have a completely idea about willingness and ability to take risk. So we're probably going to prefer different combinations of assets, even though our portfolio may consist of the same stocks. Let's just not limit to those 4 in the previous slide. We may have the same stocks, but we may not hold them in the same proportions. All right, let's move on to the one-factor model that we've learned about since our undergraduate days, right? So let's go ahead and remind ourselves of some things that we know are true. Some risk can be diversified. Maybe lots of risk can be diversified. Generally, diversification is relatively easy and it's pretty costless, right? When I was in graduate school, there was a big article written about somebody who threw darts at the Wall Street Journal and formed the portfolio throwing the darts and compared that to different kinds of strategies. And of course, the dart portfolio performed just as well, but it depended on the kind of risk that those darts actually ended up with. And so we know that rational investors will diversify. Remember, a definition of a rational investor is an individual who, in order to be induced to take more risk, is going to require some additional compensation. I'll talk a little bit more about that when we hit an illustration in an upcoming slide. And so the summary there is that there should be no premium associated with diversifiable risk. Of course, if it's easy to do and everybody does it, then for you to take diversifiable risk is not really one of the smartest decisions that you've ever made, because you're not going to get paid for taking that risk. So in CAPM, we have to ask ourselves the question, what about this relationship, an equilibrium relationship between systematic risk? And remember how systematic risk is defined. I always tell my students to think of it in this very simple term. Systematic risk is the variability in stock returns due to changes in economic factors, like those 4 factors that we described a few slides ago. What is that relationship between systematic risk and the expected return? Of course, if you're taking lots of systematic risk, then you should expect lots of compensation. Expected compensation, of course. So CAPM, which goes all the way back to 1964, William Sharpe kind of gets more credit, although there were others who did similar and identical works. William Sharpe won the Nobel Prize in Economics for his work. An equilibrium model of systematic risk and the return relationship. And look at the bottom gray box. Capital asset pricing model assumes that the only relevant factor is that market portfolio, and then the risk premiums are determined solely by beta. And I always tell my students to think of beta as having a range of between 0 and 2, although statistically it doesn't have to. In fact, when I wrote my dissertation 100 years ago, I computed the beta over about a 3-year period for, I don't remember, maybe 1,500 or 1,800 stocks. And I had a couple of them that were negative over that time period and a couple of them that were in excess of 3. But in general, people think about beta between 0 and 2, and that's probably okay. Don't tell your stats professors that I said that, however. So here are 2 versions of the capital asset pricing model. So look on the left-hand side of the equal sign. What we're trying to do is determine the expected return on an individual risky asset I, like Apple and Johnson & Johnson, and those 4 stocks that we had in that previous slide, and any other asset that's out there as well. And so this is what William Sharpe said in 1964. He said, you know what, if you're thinking about what you can reasonably expect to get out of Apple, and let's just suppose an Apple stock trade for $100 today, just so we can do some simple math. He said the starting point for this has to be what's going on in the risk-free market, right? You're not going to accept less of a return than the return or the yield to maturity on a U.S. Treasury security, right? So we're going to start with the risk-free rate of interest. So that's the RF in blue there. And then, of course, we're going to add something to it. And what we're going to add something is what happens on the floor of the New York Stock Exchange. So I want you to skip all the way over to the right under that E times RM. That's the expected return on the market portfolio. And I tell my students to think about, all right, what's going on the floor of the New York Stock Exchange? You got over 3,000 stocks. You got buyers and sellers trading, millions, sometimes tens of millions, maybe even more stocks every day. So all of those microeconomic principles apply. So William Sharpe said, all right, the return on an individual stock like Apple depends on what's going on in the risk-free credit markets and what's going on the floor of the New York Stock Exchange. Let's call that the return, the expected return on the market portfolio. But then William Sharpe said, well, what really matters is the risk premium. So we need to take out that risk-free rate out there on the far right inside of those brackets. And then that market risk premium is going to be adjusted by some measure of volatility. And so look at the second equation. There's the beta, and that would be the beta of the individual stock. That would be the beta of Apple, and that's going to be somewhere between 0 and 2. But the definition of beta, look right above it, is the covariance divided by the variance. So you have the covariance between the individual stock like Apple and that market portfolio divided by the market portfolio. And this is how I tell my students to think about beta. Beta is a measure of overreaction or underreaction. I tell my students to think of it this way. If you want a high risk stock, you're going to buy if you want lots of systematic risk, you're going to invest in a high risk stock, let's say a beta of 2. So that now I'm going to pause here and say, don't tell your finance professors I said this, because this is not exactly mathematically and statistically true, but it illustrates the point. If you own a stock that has a beta of 2, twice the systematic risk of the market portfolio, and if the market portfolio, let's say the S&P 500 index, increases by 10%, then you should reasonably expect to earn twice that, right? You have twice the systematic risk, so you should earn 20%. So there's a kind of an overreaction, right? You have more risk, so you get more return. Now, of course, it doesn't work like that, 10 to 20, but it illustrates my point. Similarly, if you have a stock that has a beta of 0.5 and the S&P 500 index goes up by 10%, you could only expect to go up by 5%. Now, that's kind of a general idea, and this is what William Sharpe was saying. He was saying, wait a minute, Jim, it's not 10 to 20% or 10 down to 5%. Use my model to figure that out. And so that's the beauty of this model. It summarizes what goes on in the risk-free credit markets. It summarizes what goes on the floor of the New York Stock Exchange, and it's weighted by the systematic risk. What did I say that before? It's the sensitivity of stock returns due to changes in economic factors. Oh boy, now we're getting somewhere. All right, so this capital asset pricing model puts tons and tons of pressure on beta to capture all of that systematic risk. All right, some quick lessons from the capital asset pricing model. The market portfolio is the only existing factor, so everyone is going to hold the market portfolio. But each investor is going to hold their optimal factor risk exposures. So highly risk-averse investors are going to choose to invest in government securities, risk-free assets. But risk-tolerant or rational investors are going to put most of their wealth into those risky assets. And so they can move up and down along that capital asset allocation line, which we'll see here in just a few seconds. And here it is. All right, the average investor is fully invested in the market. All right, so here's the Harry Markowitz contribution from 1952. So notice we have standard deviation on the horizontal axis. Eng calls this the volatility of returns, and there's the expected return on the vertical axis. And so note, you could take those 4 stocks from our beginning slide and then add another 15 or 20 or 100 stocks, and you could plot their expected returns versus their standard deviations, and they'd show up all over this map, right? But then when you try to construct this, look in red, the mean variance frontier, lots of textbooks call this the efficient frontier, which comes directly out of the Harry Markowitz dissertation from 1952, what Harry Markowitz does is he says, okay, for every given level of expected return, what I can do is I can minimize the standard deviation or the volatility of returns inside of that portfolio. And so I give this illustration to my students all the time. I say, let's suppose that Harry Markowitz throws us a bunch of assets and we're these big, strong offensive linemen. And what we're doing is we're all the way out here on our graph and we're trying to push the defense back. We're trying to push them back to the vertical axis. And at some point, we can't push any farther. And that's what the efficient frontier, and that's how the efficient frontier is constructed. Now, the tangent line, that's called the capital allocation line. That is when you add a risk-free security to the portfolio. You can get all the way over to zero volatility. So what I was saying earlier is that investors can locate themselves on that capital allocation line, right? If investors prefer much less risk, they'll start by buying the market portfolio, and then they'll buy bunches and bunches of treasury securities moving downward and to the left on the capital allocation line. If they prefer more risk, they'll start with the market portfolio and then use things like margin accounts and lines of credit and derivative securities to move upward and to the right on the capital allocation line. Now, the exposure to that risk factor, of course, must be rewarded. And it does this inside of this capital allocation line. But let's suppose, here, let me go back here. Let's suppose that we take every investor's capital allocation line and we add every other investor's capital allocation line to this equation. We get something called the capital market line. And that capital market line, of course, is in equilibrium, and we can identify the risk premium by that bolded formula in there. All right, so look on the left side of the equal sign. We have the expected return on the market portfolio minus the risk-free rate. So that's the market risk premium is equal to, and notice what's on the right-hand side of the equal sign. There's the variance in the market portfolio. There's our factor, right? And then we're going to adjust that by gamma, which is the risk aversion for each individual investor. But then, of course, when you do this with the capital market line, that becomes the risk aversion for the average investor. So look at the arrow point at the bottom. When the average investor's risk aversion increases, the market risk premium should also increase. And hopefully that makes perfect sense. All right, a couple of final ones here. I think I mentioned these. Beta is the function of the market variance and the asset's co-movement. So co-movement means covariance that we had back in that formula on a previous slide. So risk is measured as a beta exposure. That's systematic risk to the market portfolio. And then value assets have low risk premiums, right? Assets that show losses during periods of negative market returns have high betas, right? Indicating that they should have high risk premiums. Now, I love talking about the lessons that we can learn from the capital asset pricing model because when I was in graduate school, right, in the late 80s and the early 90s, my professors, we loved the capital asset pricing model. We loved the arbitrage pricing model. And we talked about these all the time. And then every once in a while, the professors would say, please note that capital asset pricing model is not perfect. And so I would scratch my head and say, all right, is it just a little bit imperfect or is it a lot imperfect? And over the years, we have discovered that the capital asset pricing model provides us with a great foundation. But like lots of things, we need to try to add to our understanding of it by doing some other stuff. So let's go ahead, before we get to that other stuff, take a look at some of the failures of the capital asset pricing model. And I would prefer to think of these as just some assumptions that William Sharpe and others made that might not mimic reality. All right, so of course, investors only have financial wealth, but we know that there are things up here in our brains, and things in our body, so we can work hard. So there's this labor income risk that the CAPM does not consider. Capital asset pricing model also assumed that investors operate in a mean and variance world. And so their utility, their satisfaction from investing comes from the simple fact that stock returns follow a normal distribution. You can identify the mean and you can identify the variance, but it ignores things like skewness and kurtosis. So look at that first arrow point there. Investors in reality have an asymmetric view of risk. And what that means is that from a statistical standpoint, that there's probably not going to be a normal distribution. There's probably going to be skewness and maybe even some kurtosis. We talked about that in one of the previous lessons. This is what we know. Investors dislike losses more than they like gains. And so this brings into the specter of downside risk that probably has its own factor in and among itself. Single period investment horizon. I was never too bothered by this. One of my professors showed us an intertemporal capital asset pricing model. So while this is true, there are some extensions of CAPM that kind of handle this. But of course, investors continuously, do we want to say that? They regularly or frequently rebalance their portfolios. Another assumption is that when we show up on the floor of the New York Stock Exchange, we all have the same ideas, right? We're all processing this information up here, and we're processing it at the same speed, and we're coming up with identical conclusions. But of course, we all have heterogeneous expectations. What do we have written in bold there? Rarely share similar beliefs. Back in the 50s and 60s and into the 70s, lots of these modern portfolio theories relied on the assumptions that, we didn't really have to pay any transaction costs. There were no bid-ask spreads. And if there were taxes, they didn't really affect returns. So that's a big deal there. Markets are frictionless. Of course, we know that to be not true. All investors are price takers. This comes from the simple fact that, remember, the discipline of finance was essentially created in 1958 by Modigliani and Miller, but nobody earned a PhD in 1950s or the 1960s. So all of these fathers of modern finance were economists. And so, they relied on this assumption that markets were perfect and that everyone came and whatever the price was, well, there it was, and you couldn't do anything about it. But we do know that there is the potential, and this has been shown pretty regularly, that institutional investors at times can cause significant price movements. And then finally, information is free and available to everyone. Didn't the great economist Milton Friedman say something about there's no free turkeys or no free chicken sandwiches or no free lunches? So. All right, so because of I really don't like hearing about the failures of the capital asset pricing model. I would like to refer to them as limitations, but of course, I'm not going to argue with this esteemed professor who wrote this chapter. But so CAPM has some failures or limitations, however you want to view it. So, and those limitations are based on what we just talked about, but also the fact that there's tons and tons of pressure on the capital asset pricing model and the market portfolio and beta to capture all of those factor risks that are out there. And so that's why we move to the multi-factor models. So we have these multiple risk factors that can influence the return on individual stocks. All right, let's do a quick comparison of the two before we get into some of the mechanics of the multi-factor models. All right, so in both of them, lesson one, diversification works, okay? And it doesn't work exactly in the same way under both models, but diversification works. Lesson two, each investor is going to find their own preferred position on that efficient frontier or the capital market line. Now, they're going to do it in two different ways, but they still find their way onto that efficient portfolio. Lesson three, of course, average investor holds the market, but In the capital asset pricing model, they're going to linearly move away either above or below from that using treasuries or maybe derivative securities. But in the multi-factor model, they're going to move perhaps non-linearly, but perhaps linearly away from the market portfolio based on their exposure to each factor, like maybe interest rates are super important or maybe GDP changes are super important. Lesson 4, market factor is priced in equilibrium under CAPM. Of course, there's lots and lots of good calculus in the capital asset pricing model, and the same holds true for multi-factor models, but it's going to be those risk premiums under these no arbitrage conditions that determine equilibrium in the multi-factor models. Lesson 5, we have beta in CAPM and we have factor exposure. So we're going to have a factor exposure to interest rates. We're going to have a factor exposure to changes in GDP. And let me pick a silly one here. We could have a factor exposure to the number of clouds in the sky. Of course, hopefully that factor would be 0. The final lesson, bad times under CAPM are explicitly defined as low market returns. But assets that pay off in bad times are attractive. And so we can find those attractive assets in the multi-factor models, or at least that's the goal. Let's go ahead and move on to stochastic discount factors and relate these stochastic discount factors to the multi-factor models and the capital asset pricing model. So what I want you to do is I want you to think about this, and I'm gonna use just another weather example here. I have a cousin who lives about 20 minutes from me, and we talk regularly every day. And when it's an overcast day, we always have a conversation about the weather. Is it raining at your house? Is it raining at my house? And regularly, one of us will say something like, you know what, it's just drizzling. There's not much rain outside. And the other one will say, well, it's pouring down rain here. And so I think about this in relation to these stochastic discount factors and multi-factor models. Look, when it's raining at my cousin's house and it's pouring down rain, he can't do anything. He has to stand at his window and look outside at his yard and say, boy, I got all this stuff to do out there. I can't do it. But here at my house, if it's only drizzling, I can go out and I can cut the grass and I can trim and I can plant and I can do all sorts of things, right? So the overcast, think of that as kind of the market portfolio in the capital asset pricing model. But the actual rain clouds, think of those as the multi-factors that are affecting our ability to, keep our yard in good shape. So think about that, and then think about how this relates to what we're talking about with CAPM and the multi-factor models. Let me go ahead and give you an example of pricing. So look at this first circle point there. Factor risks represent exposure to bad times, and these exposures are rewarded with risk premiums. So let's introduce this stochastic discount factor. All right, so you ready for this? So let's suppose that I come to you and I say, hey, I have a security that's going to pay off $100. And let's suppose this $100, I promise to pay you $100 in 1 year. How much are you going to pay me today if I promise to pay you $100 a year from now? And of course, you're going to say, well, Jim, it depends entirely on what you're going to do with that money. And I say something like, all right, how about if I go out and I buy a treasury bond? And let's further suppose that I'm not going to charge you anything for my services. Forget about transaction costs, right? And so you say, okay, treasury bonds, all right, how about I'll pay you $97 today, right? And so that'll be some risk-free rate of interest. So you give me 97. I go invest in treasury securities, and they pay off at 100, and then I give you your 100. Remember, I'm doing this out of the kindness and love of my heart. I'm not charging you anything. So your stochastic discount factor would be 0.97, let's say, right? You would pay me 97% of that expected payoff. This is called the pricing kernel. But on the other hand, if I said to you, I'm going to go out and buy the highest and the riskiest equity security possible, And this company is in the technology industry, and they do they're on the learning curve, they're on the edge, and they're doing all this research and development. And you scratch your head and say, okay, if you're going to pay me $100 a year from now, and you're going to invest in this highly risky equity security, maybe I'll give you $60 today, or maybe $40 today, or $70. I mean, whatever that is. So your stochastic discount factor would be, let's say 0.6 or 0.4, whatever that is. And then if I said, hey, I'm going to take this to Las Vegas, and I'm going to play the slot machines, and I'm going to bet on horses, and I'm going to bet on football games, and I'm going to bet. And you scratch your head and say, Jim, you're probably going to lose all of your money, but you might double your money or triple, or maybe you'll come back with $1 million. Maybe I'll pay you $1 for that or something. And so you would have this huge stochastic discount factor. All right, so you get the sense calling this an asset pricing kernel has to depend on what I'm going to do with your capital. Now, I want you to break this up into different factors as well, not just the big overcast day that occurs between my house and my cousin's house, not the overcast day on the floor of the New York Stock Exchange, but let's find those pockets of rain clouds so that we can more accurately price that security depending on whether we think it's going to pour in our backyard or not. So look at that circle point. It is effectively an index of bad times, where each bad time is associated with a given risk factor or economic state. So don't think about this just entirely of what I'm going to do with the money, with your money, but what factors are going to influence the performance of the security that I pick. And we'll identify those factors. All right, so let's look at the bottom blue block there. So what we're saying is that this stochastic discount factor M is going to be a function of some constants A and B and the return on the market portfolio. And so forget about what those constants are, A and B, but what you're going to do is you're going to go out and say something like, okay, if you believe in the capital asset pricing model, I'm just going to have one overcast cloud. But if you believe in the multi-factor models, you're going to believe in not only the one overcast cloud, but all of these individual rain clouds to determine what that stochastic discount factor is. So this one here in blue is just the regular old CAPM, but this one here in the next slide is the regular old multi-factor models. And so look at how cool this one is back here, right? So this M is going to be determined based on the big cloud, right? The market portfolio. But here, this M, this stochastic discount factor is going to be determined by, well, what were those four factors? Interest rates and changes in GDP, maybe inflation, and the market portfolio in there, or maybe some sector market portfolios inside of there. Notice that that equation goes all the way out to subscript K over on the right-hand side. So you could have factor 1 and factor 2. We started with just 4 factors, but you could have 10 or 20 or 80. I mean, 80 is probably too many. What we'll talk about in either the next chapter or the following chapter, we're going to talk about which are the important factors that are out there, and we're going to actually test and discuss the results of those. And so notice the K's represents the bad times. This is the terminology in the chapter. Oh boy, so notice the stochastic discount factor M in the multi-factor models overcomes one major problem associated with CAPM. All right, so this is important. And I said this in one of those previous slides, right? You're going to move, if you believe in the capital asset pricing model, you're going to buy the market portfolio and then move in a linear fashion, either up and above or below and to the left from the market portfolio. But that is a line. Remember, that's called the capital market line. That means it's a line. But in reality, M exhibits a non-linear relationship with those factor risk returns. So remember what I said, you're going to move away from the market portfolio. You may move linearly, but you're probably not going to be, because the relationship between interest rates and the returns on your portfolio or an individual stock are probably not going to be linear. Now, how are these pricing kernel used? All right, so look at this equation there. So the price of an asset is the expectations of M times the payoff. So this is a summary of what I was telling you about, given, what did I say, Treasury securities or a super high risk equity security or Jim going to Las Vegas. All right, so payoffs are discounted using M as the factor, hence the name stochastic discount factor. Now look at the second part there. This is cool. Working out the price when it's contingent on some events. Oh my gosh. So here we have, in our example so far, we just talked about some equity securities, right? Some risky equity securities. But what about those securities that have embedded options in them? They have contingencies. Well, the reality of life is that those stochastic discount factors are not, of course, constant over the promise. What did I make you that promise? Over a year. So it's not like you're going to say, hey, today I'll pay you $97 for that investment in government securities, but a week from now, I may go to somebody else and offer them the same security, and they may say, oh, I'm only going to pay you $93. So these stochastic discount factors, they're dynamic. Of course, they change over time. And of course, it's the only way that you can price a security that has these contingent claims in them. All right, let's summarize our day here by discussing efficient markets hypothesis, which of course was developed by Eugene Fama somewhere in the late 60s and early 70s. And Eugene Fama said the following. It's really super simple. Eugene Fama said, look, the price of Apple, the price of any financial risky security out there has to be a function of the relevant information and the available information. If we're looking at a company like Johnson & Johnson as one of those four in our original portfolio, what is relevant piece of information? Of course, things like interest rates and inflation, those are general market factors, but there are also pieces of information that are unique to Johnson & Johnson, right? Baby shampoo, right? They make surgical products. They also are at the cutting edge of all sorts of research in vaccines and all those kinds of things, and helping doctors develop vaccines. So they provide technology. And all right, so what's important about Johnson & Johnson? Those are relevant pieces of information. Go back to my silly example from 20 minutes or so ago about the number of clouds in the sky. I mean, if you counted the number of clouds in the sky and said, oh, there's 27 of them there today, I'm going to run to the floor of the New York Stock Exchange and buy shares of Johnson & Johnson. Well, that's not going to be an important factor that is priced into the market. And so look at the second teardrop point. If markets are efficient, then there is no way to beat the market, because all of the prices reflect all of that relevant and available information. And all of that information is processed by all of us really, really smart men and women out there who are seeking this information, and we're processing this information. And then we're efficiently pricing that information. So look at the bottom there. There are no undervalued or overvalued securities. Finally, as the quality and amount of information increases, the market becomes more and more efficient, which means the arbitrage opportunities are in fact wiped out. All right, so that's the efficient markets hypothesis. So let me go ahead and ask this question. Are markets efficient? Boy, this chapter says definitely no. The way I teach it to my students here is that I say that the markets are generally efficient, but there are pockets of inefficiency because of things like information asymmetries, because of market psychology, because of transaction costs, and because of human emotions. So you have these individuals that have emotional biases. And these emotional biases and market psychology, like momentum and transaction costs, and the simple fact that executives know way more about the product lines than I do or we do as investors. So because of these inefficiencies, because of these pockets of inefficiencies, there are overpriced or underpriced securities, which result in the pursuit of excess profits. And that's, of course, why there are tons of financial analysts out there who are paid lots of money to find and take advantage of these pockets of inefficiency. Boy, that was super fun for me. I sure hope you guys enjoyed my personal experiences with capital asset pricing model and then the multi-factor models. And so, clearly that first learning objective is important, but once you understand those, there'll probably be a question about factors and what that factor risk premium is. But then the more interesting questions would have to be about CAPM and the multi-factor models, and then how the SDF is used to price securities. And then, of course, how it relates to the efficient markets hypothesis.